Let's be real. If you've ever tried to scalp gold, you know it can be an absolute monster. One wrong move and bam, your trade is gone. So today, we're going to cut through all that noise. I'm going to give you a clear step-by-step roadmap with 3 really powerful strategies built to tame that beast. So here's the plan. First, we'll get a lay of the land, understand the battlefield and why gold is just different. Then we're diving straight into the good stuff. 3 totally distinct, actionable strategies. We've got the liquidity sweep, the trend rider, and the character shift. And to wrap it all up, we'll pull everything together into a framework you can actually start using.
All right, first things first, we have to understand the battlefield. Seriously, before you even think about applying a strategy, you've got to respect the wild environment you're stepping into when you trade gold.
Yeah, this quote just nails it, doesn't it? Fast, aggressive, and extremely unforgiving. I mean, that's gold in a nutshell. It is not for the faint of heart. That speed, that aggression, it demands that you have a super precise, rules-based approach. And hey, that's exactly what we're here to build today.
So, when we say gold, what are we really talking about? Well, in the Forex world, it's XAU/USD, right? Gold priced against the US dollar. But what's cool is that these same principles we're going to talk about, they totally apply in the crypto space too, with things like Pax Gold or Tether Gold, which are basically digital tokens backed by real physical gold.
So why do traders love scalping gold so much, even though it's so tough? Well, this right here is why. You've got massive volatility, deep liquidity. That means there are always moves happening. But here's the secret sauce for us. Gold tends to respect major price areas. It hits a big level and reacts. And that single characteristic, that's what all of our strategies are built to take advantage of. Okay, listen up, because this is probably the single most important slide. This is the cornerstone of everything we're about to discuss. We are not just guessing here. The process is always the same. We find the bigger story on a higher time frame, identify our high probability zone, and only after we've done that homework, do we drop down to a lower time frame to look for a precise entry. This 2-step dance is the key to everything. All right, let's dive into strategy number 1, the liquidity sweep. This one is super fun. It's all about catching those really sharp, aggressive reversals that happen right after the market runs a key level and grabs a bunch of liquidity. So here's the play-by-play. On your higher time frame, maybe the 15 or 30-minute, you're watching for price to take out a key high or low, a liquidity sweep, and then it sharply reverses, breaking structure. That's your first clue. You then mark the order block, basically the last candle that kicked off that whole move. Now you wait. When price comes back to that spot, that's when you zoom in. On the lower time frame, you're looking for a very specific confirmation. You're looking for a small price imbalance, a fair value gap to get violated, and then flip into support or resistance. We call that an inverse FVG, and that, my friend, is your green light. Okay, so you've got your signal. Now what? You basically have 2 choices, and this is a classic trader's dilemma, right? Option 1, you jump in with a market order right away. You get in fast, you don't miss the move. Option 2, you can be a bit more patient, place a limit order right at the edge of that IFVG, and try to get a much better price. The trade-off is simple, a potentially way better risk to reward versus the very real risk that price just takes off without you and never comes back to fill your order. There's no right answer, it's about your style. So, let's say you're in the trade, it's working, you're in profit, things are looking good. The big question pops into your head. Is there a safe way to add to this winner and really maximize it? And the answer is absolutely yes. Here's how. As the price keeps moving in your favor, you look for the next little break of structure. In that move, you're hunting for a new, fresh fair value gap that hasn't been touched yet. One of those price imbalances? That gap acts like a magnet, and it becomes a super high probability spot to add a second entry and ride that momentum. Okay, moving on to strategy number 2, which I call the trend rider. Pretty self-explanatory, right? This one is not about trying to catch a falling knife or predict a top. This is all about finding a strong, established trend and just joining the party at a really smart pullback spot. With this one, patience is the name of the game. First, on your higher time frame, you need proof of a trend. And I mean real proof, like at least 2 solid breaks of structure going in the same direction. Once you've got that, you identify the key supplier demand zone that kicked off that last big move. Then, you just wait. You wait for price to pull back into that zone. As soon as it taps in, you zoom down to your lower time frame for confirmation. Here, you're watching for a small shift in market structure, a sign that the pullback is running out of steam.
And your super specific entry signal? It's a pattern called a breaker block. It's basically a failed swing point that flips into support or resistance. That's where you can set your limit order and get ready to ride the trend. And finally, we have strategy number 3, the character shift. This is the big one. This is the setup you look for when you think a major long-term trend might be about to die and reverse. It's all about trying to get in on the ground floor of a whole new move. So here's the game plan for this one. First, you need a really strong, obvious trend. I'm talking at least 3 solid pushes, something that looks like it might be getting a little tired. Then you patiently wait for the first major sign of weakness on that higher time frame. We call this a change of character, or CHOCH. It's when price finally breaks the structure of the last pullback. That's your alarm bell. Inside that big reversal move, you identify the fair value gap it created. You mark that zone and you wait for price to come back to it. Once it does, you know the drill. Zoom in, and just like our first strategy, you wait for that inverse FVG to form on the lower time frame. That's your final confirmation and your entry trigger.
And look at that. We're back to our old friend, the entry dilemma. Once you see that confirmation signal, do you smash the market button to make sure you're in? Or do you try to finesse a better entry with a limit order for a better risk-to-reward ratio? Again, no single right answer. It really just depends on your own trading personality and how fast the market is moving. Now, if you're the kind of trader who wants to stack the odds even further in your favor, you can definitely add more filters. For example, you could say, I'm not even going to look for an entry until price fills at least 50% of that big higher time frame FVG. But you always have to remember the trade-off, right? Adding more rules, more confluence, can absolutely boost your win rate. The downside is you'll get fewer trades, and you're probably going to miss some of those really explosive moves that don't offer a perfect pullback.
Okay, so we've covered 3 really powerful but very different strategies. Let's wrap this up by putting it all together into a simple framework so you know exactly how to think about this. You're going to want to screenshot this slide. This is basically your cheat sheet for timeframes. For those quick hitter liquidity sweeps, you're doing your analysis on the 15 or 30 minute, and you're executing down on the 1 or 5. For the trend rider strategy, a great combo is the 1-hour chart for your analysis and the 5-minute for your entry. And for those big, juicy character shift reversals, you need to zoom out. Think 4-hour or 1 hour for the big picture, and then maybe the 15-minute for your execution. Seriously, if you forget everything else, please remember this. Even though we talked about 3 different strategies, they all boil down to the exact same 2-step process. Step 1, find a high probability zone on a higher time frame. Step 2, wait patiently for a specific, non-negotiable confirmation signal on a lower time frame before you even think about clicking a button. That's the whole game. That is the core of this entire system.
And there you have it. 3 complete rules-based roadmaps for taking on gold. You've got one for reversals, one for trends, and one for major market shifts. So the only question I have for you is, which one are you going to take to the charts and start backtesting first?